really showing you that they prefer physical delivery, and this is a dangerous game that is being played at the highest of levels and now right in front of your face. So it's to bail out a big player who's off sides with zero time left to make good on that delivery obligation. The big shareholders, the banks, these are the ones that have all the seats. And it's the same thing that happened in 1980 when the Hunt brothers witnessed the exact same situation we see here. Then deliveries can explain. In fact, it's 164% of February delivery demand. This is a classic sign, not only of tightening physical conditions, but lack of trust. So more metal in the month of February has left than has been delivered. And left the building. Breaking above the $90, what seems to be imposed line in the sand. People are waking up, Michelle, to the split between real physical gold and paper gold, and silver for that matter. And this is the reason people say if you don't hold it, you don't own it, because these games that are being played at the 12th hour in a system that is based on confidence is starting to, in my mind, greatly erode the confidence in the Comex. And if this is the case, this is just the very beginning and what we can expect to see in more shenanigans, twice on the upside, stopping it, not stopping it as the price is falling, and stopping it as the price is rising, saying the server overheated, or in this case, just saying it was a technical issue. But when it fell very hard, oh, the circuit breakers broke, it was a glitch, and letting it fall. This is quickly getting into a situation, I think, where big traders would be very foolish to leave their metal within this ecosystem. And we'll talk about all the silver leaving Comex, which is crazy in the month of February, but it's not a good thing, and it's greatly eroding confidence in the system. Big players who don't have the metal to deliver. We've been seeing a repetitive trend of standing for delivery. Again, this is a market in backwardation where in your possession now is preferred over holding it into the future. And fool me once, shame on you. Fool me 2, 3, and 4 times, shame on me. And for even believing that the system is legit. And you're right, the rumor is that 31,828 contracts were dumped onto the market while the public was locked out. And then when the market opened, silver was slammed by over $4. And again, I'll just say, remember November, what was it, 28th, the same trick. And after that happened, silver went up 120% in 60 days. You can only manipulate a market for an extended period of time by pushing it in the direction that it is going. And this market has never gone this way across the globe, with the biggest traders really showing you that they prefer physical delivery. And this is a dangerous game that is being played at the highest of levels and now right in front of your face. So it's to bail out a big player who's off sides with zero time left to make good on that delivery obligation.
Questions swirl around CME halts. Who benefits and why? Some allege a massive silver sell order coincided with the pause, potentially suppressing the price. Historical patterns show that interventions often protect large banks or funds, echoing events from 1980 and November of last year. Market participants increasingly distrust futures trading platforms. Exchanges in Shanghai, Dubai, and Singapore are gaining attention as alternatives, emphasizing transparency and physical delivery. While we can't confirm motives, evidence points to strategic interventions designed to stabilize or manipulate prices. The result? Western traders face widening gaps between paper and physical metals, challenging conventional assumptions about market fairness.
The big shareholders, the banks, these are the ones that have all the seats. And it's the same thing that happened in 1980 when the Hunt brothers witnessed the exact same situation we see here. More contracts than bars, buy up all the contracts, stand for delivery, and they made the market, at that point, sell only, and collapse the price. And so these are the games that the CME group plays in a desperate attempt to keep the game going. But when you realize that there are not only exchanges in Shanghai, in St. Petersburg, the new BRICS proposal, in all throughout the Belt Road Initiative, all of these exchanges that are being built, but in particular the ones in Shanghai and Dubai, Singapore, These exchanges are saying, chomping at the bit, saying, you know, if this is what we can expect in the global price setting hub and the problems we've seen at the LBMA, they're just waiting for the opportunity for this to blow up in terms of lack of trust and move price setting to the part of the world that understands and appreciates and accumulates physical metal. And they've been using this against us in terms of our price setting and our price manipulation. And this is a desperate attempt at the last minute to help a entity, a bank, a big fund who is massively offside and had run out of runway. And you don't want the exchange to blow up. So this is probably lesser of two evils, I guess.
When you say run out of runway, do you mean they did not have the physical silver to deliver?
They didn't have the physical silver nor the time to get the physical silver. So this, you know, pause it, make some phone calls, get some help involved, or the exchange, you know, goes through some form of a cash settlement, force majeure, or bigger problem altogether.
Silver prices now differ dramatically across regions. Shanghai shows premiums over Western prices, creating lucrative arbitrage opportunities. Traders can buy low in the West, deliver to Hong Kong or Shanghai, and navigate VAT taxes to profit. This disparity reflects the real value of silver where it's respected and hoarded. Persistent premiums suggest that physical supply is constrained, forcing traders to adapt strategies. Meanwhile, the West faces growing skepticism of price integrity. The gap between exchanges highlights global shifts in influence and trust, with Asia increasingly setting the benchmark. Understanding these flows is critical for investors seeking to navigate volatility and protect assets in an unpredictable market.
CFTC has been lame all along. We go back and, you know, look at the JP Morgan settlement of $920 million by the Treasury Department for spoofing, or the Justice Department rather, for spoofing, and many thought they should have been brought up on RICO charges. You look at Bart Chilton's admission that this stuff happened and said it on the Arcadia Economics podcast and also on Andrew Maguire's podcast that, you know, largely Bear Stearns went bankrupt because of this, and JP Morgan took over the position. They violated the agreement. And when Bart Chilton, who was the head of the CFTC, went into Hank Paulson and Ben Bernanke's office and said, they're in violation of our agreement and of antitrust law, they need to be prosecuted, he was told to back down, Bart, it's a political decision. The point is that this has been going on for a very long time. And the difference now is that you have players around the world who are coordinated, motivated, and sophisticated and are just looking for reasons to abandon the Western system. And I'm not saying we're there yet, but anyone who would trust a system that is repetitively protecting their own rather than letting the market trade freely, I think would be silly to continue to use it as the central hub for whatever they're trying to do legitimately.
February contracts reveal a startling trend. More silver has left Comex than has been delivered, totaling nearly 39 million ounces. This 164% withdrawal ratio signals a severe lack of confidence and tightening physical conditions. Large investors are removing metal, likely for industrial, investment, or national security purposes. The logistics alone, semi-trucks, armored transport, secure storage, underline the scale of this movement. Analysts warn that these withdrawals are a precursor to market stress, highlighting the fragile link between paper contracts and tangible assets. As silver increasingly becomes a strategic resource, trust in traditional exchanges continues to erode, reshaping the global metals landscape.
You know, largely centered around a VAT tax. So right now the price in Shanghai is about $11 higher than the price in the West, and that would entice an awful lot of arbitrage. Normally arbitrage ends quickly as the sophisticated traders flow to the arbitrage environment to buy low and sell high, but that ends quickly. It hasn't. It's continued, and it's as if they're doing this 100% purposely to incentivize Western traders to buy in the West, probably deliver to Hong Kong, which is a Comex contract, and have it trucked over to Shanghai. The VAT tax is in addition to this in terms of what the Chinese are paying. What I mean is that a lot of people say, well, what about the VAT tax? Doesn't that offset it? The VAT tax is the responsibility, typically, of the recipient when it leaves the Shanghai Metals Exchange. So a trader who was able to buy in the West, deliver in China, would not be responsible for that VAT tax. It is the responsibility of the account holder on the Shanghai Metals Exchange when that metal goes somewhere else. Then that VAT tax is paid. So in essence, it's in addition to the Western $10 premium is this big VAT tax that they are willing to pay because the dollars that they are unloading, that they've been choking on from our trade imbalance, are worth less than the metal that they are accumulating, even at a much higher multiple. I think, again, it shows what the real price of silver is in places where it is understood and respected versus the games that are being played here that are, you see what happens. These games will have consequences that will start to become more and more obvious and more extreme, as we're seeing, for example, since Thanksgiving, of this kind of nonsense. And I think this will be just the beginning as players try to pull their metal off the exchange, which is something I want to talk about.
Okay, so when does this manipulation sort of come to a head?
When there's no metal left to play with. And we're seeing that right now. I mean, we're beginning to see that right now in February. The February contract, which comes off the board completely and totally, which is still open. This late in the game, it's unbelievable to see this kind of open interest on the February contract. But echoes
what does that mean? Open interest on the February contract?
Open contracts that haven't settled yet, and with 2 days left or 3 days left in both gold and silver. And what's interesting is that if you look at so far as of yesterday, the February cumulative deliveries amounted to just under 4,700 contracts at 5,000 ounces apiece. It was 23,195,000 ounces have been delivered onto Comex. It doesn't mean it left, right? It was delivered. But here's the interesting thing. As of yesterday, actual February withdrawals leaving Comex were 38,082,934. So that is 15 million more ounces than deliveries can explain. In fact, it's 164% of February delivery demand. This is a classic sign, not only of tightening physical conditions, but lack of trust. So more metal in the month of February has left than has been delivered. And left the building.
Mexico, the world's largest silver producer, faces escalating cartel violence following the death of a major leader. Retaliatory attacks threaten mining operations, transport, and investment. With Mexico producing a quarter of global silver, supply disruptions could push prices higher immediately. Industrial users, battery manufacturers, and strategic reserves are on high alert. Governments may classify silver as critical for national security to mitigate risks. The instability underscores the geopolitical dimension of metals. Natural resource security is intertwined with law enforcement, cartel influence, and corporate operations. Investors must now factor in both criminal activity and international politics when assessing market risks and long-term value.
Who can take possession of almost 38,100,000 ounces of silver? If a mint box of Silver Eagles, which is 500 ounces, weighs 42 pounds, who's taking possession of 38 million? You're talking an armada of semi-trucks. Where is it going?
Where is it going?
I don't know. Is there any coincidence that this is happening leading up to not only the admission or declaration that silver is a critical mineral, but they're going to impose state-sponsored price floors and or strategic stockpiles? Is that what it means? Could it be the Exchange Stabilization Fund doing this covertly on behalf of the Treasury Department for national security? Could it be? Sure. I don't know who it is. Mm-hmm. But a lot of the metal that is being delivered is actually leaving, not all of it. And so I want to be very clear on that. Some of it stays within the Comex ecosystem. But I would venture to say that a lot of the people are starting to question the wisdom of leaving it in the ecosystem with this kind of nonsense happening.
Well, is it being delivered because it's needed for industrial use? I mean,
sure,
would that make sense?
Absolutely, 100%. Especially if you need it for industrial use and you see the kind of nonsense that is being played over and over and over again in terms of desperation to keep it from going too high, or just let it fall as far as you want, and the circuit breakers where, there was a glitch. These are things that that one time it's an outlier. 4 times within, a couple of months, you start to question the wisdom of trusting said institution.
But again, and this is granted speculation, but how do you think this plays out? Who calls whom at the CME and says, "Hey, do me a favor"? Like, how do you think this plays out behind the scenes?
Who would be silly enough, or who has the clout to do that? My only guess would be the shareholders of the CME group, which are the big banks, and even the government, who is listed on the CME website as we do trade for national governments or for central banks they trade for. And now that metal has been classified national security priority, these things, I guess, shouldn't be that hard to imagine if it is in the sake of or in the name of preserving the integrity of not only the exchange, but some of the very, very big players who have been trying to get out of these positions, arguably. We're 4 days before the February contract has to deliver. Has to. 3 days now. As of yesterday, 4,366 contracts are still open. This late in the delivery cycle, everyone's focusing on March, which comes off the board also on Friday. But to see February still open is 24 times normal right now to have this kind of volume, 13.5 tons that is still open. It's insanely high for this late in the cycle, even bigger than the March contract before they just knocked all of the open interest out of it. So, in other words, you have someone who is short and hasn't closed out for weeks. And if they were planning on buying it back, it appears that they were trapped. But the point of it is that how do you have, with 3 days, 2 days left to deliver this much in open interest in gold and silver still standing for delivery? It's a massive red flag, and I think, again, this is a market that works on confidence, and the moment the market believes there isn't enough metal, this leverage unwinds, and in commodities unwinds violently. That's what they tried to stop, in my opinion.
A violent unwind, which would mean what?
It would mean a failure to deliver. It would mean a cash settlement, a force majeure, an admission of a paper Ponzi scheme. It's the lesser of two evils. And how many people are really paying attention to 4 glitches since November? I don't know. We are, but I don't know how many other people are.
Silver's role is evolving from a commodity to a strategic asset. Trading halts, global arbitrage, Comex withdrawals, and supply shocks converge to create a fragile market. Prices fluctuate within broad ranges, with ceilings near $90 and floors around $70. But shortages and global demand suggest upward pressure. Strategic stockpiling, industrial use, and geopolitical tensions may fuel volatility and potential surges. Investors are adapting, increasingly favoring physical possession over paper claims. As national security considerations take precedence, silver and other critical metals will remain central to both economic and strategic planning. The question remains, who will control the metals that power the world?
Because it's just, any of the big traders would have to understand what this actually means. And again, when you see vault withdrawals, 164% of the February delivery demand, again, this is telling you that players would rather pull that out, deal with the logistics, the security, the insurance themselves, because they don't trust leaving it within the Comex eligible category. This is insane. And if we look at the March 2026 open interest 2 days ago, it was almost 48,000 contracts representing 240 million ounces. They just knocked the hell out of it and got it on sides. And again, but at what cost? They got it down to just under 10 million open interest, that there is enough silver to be delivered, but at what cost? When you see the market close after starting to move up, close or shut down because of some fault, and then open up and get clobbered right then and there, it just becomes so obvious. If it were me and I had this kind of exposure to the market, I would stand for delivery and I would pull it the hell out of the exchange as fast as I possibly could, because it's telling you by their actions, regardless of who said to do it and who was behind it, it's telling you by their very actions, it's a system that cannot be trusted anymore. Right. I think absolutely you would have some form of disruption. I think if you're a board member watching what happened, I think it was Visalia, if I'm not mistaken, where 10 of their board members were kidnapped and murdered. recently. And now you see this, where the majority of these mines are in Mexico, and at what point do you start to question the wisdom of that? There's always been the overhanging threat in any mining endeavor of geopolitical risk. This takes it to a whole new level, and I think it would have a profound impact, 100%, at least until things get under control.
How quickly, well, what would the timeline be for this supply issue to start being seen in the prices, do you think?
You would think it would be immediately. If indeed they have if this massively disrupts the supply chains in Mexico. You hear that rumor of Samsung flew to Mexico to open up a mine for all of their doré and concentrate in order to, facilitate their battery operations. What does it do to a company like that? Do they rethink their problem? Are they some of the ones that are pulling the metal off of the exchange because of what they saw? This is a situation where it becomes even more imperative for the U.S. to do things like classify silver as critical, because supply chains are being disrupted. And not only that, the exchanges by which these commodities are freely traded seem to be less than sincere. And when you realize we're now in the 6th year of a supply-demand imbalance into the billions of ounces cumulatively, 200-300 million ounces a year, this becomes a real problem when you are putting a big question mark in front of the very largest producer of silver in the world. Yeah, it has to have a problem.